Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. I got a question the other day about target date funds, and the question was, can you explain what target date funds are? Like, are they important? What should you do as an investor when it comes to target date funds, and like, how do these things work? So, interesting story about target date funds. I would not be here without target date funds. I say that because back on September 24th of 2010 is when I started Building Bread, which means that months before that, I took my first internship at ING Investment Management, where my job was to understand target date funds. So it all comes back full circle. So essentially, target date funds are mutual funds. Mutual funds are collections of stocks and bonds packaged together for you to buy just one thing that can do multiple things. Think of it like, I don't know, a combo at your favorite restaurant. In either case, though, target date funds are built to adjust with you. So what I'll do real quick is just show you this this picture from NerdWallet, and you'll see that blue section is they say equities, which again just use stocks and bonds. But in either case, when you start off in your investing journey here, you're supposed to start with more stocks than you do bonds. And the older you get, aka the closer you are to retirement, you want to lower that risk. And these glide down where they become more conservative the closer you get to your target date. So that is how these things are supposed to be designed. Think of it like autopilot. I put my money in. If I start early in my 20s and 30s, I'm going to have more stocks, and then as I age and get close to retirement, they glide down and it just changes for you. Now when you log into your 401k, and I'll actually put a picture of my 401k up here, you'll see these different dates. And I've seen people make this mistake a few times. Essentially here, you're choosing your target date. So when you start the job, again, you're assuming here that you're starting in your 20s or 30s, primarily in your 20s, you're picking the closest date, the closest year rather, where you are 65. What you don't want to do is come in here and you're like, yeah, I just started my brand new job and I'm going to pick the 2025 fund. Now, while I would love to just get in and get out and just be done working in just 3 years, that is actually the most conservative portfolio option. You want to pick the one that is further out so it can be more aggressive, grow for you, and then become more conservative as you start to approach retirement. That's basically it for target date funds. Now, what are the pros and cons? So the pros are, if you are somebody that wants to be hands-off and you don't want to have to rebalance your portfolio and buy and sell different stocks and try to figure out where you should be at all times, a target date fund is for you. This is built for you. It's autopilot, it's straightforward, simple, and easy to understand. And really, you only need one. That's it. Let's say if you were planning on retiring in 2045, put everything in your 2045 fund, the stocks, the bonds, all that stuff is going to adjust for you. You really don't have to do anything else. That's the biggest advantage. You don't have to sit here and worry about, well, do I have too much stocks? Do I need to go back and do all this tweaking and rebalancing? You don't have to do that. I have to do that because I don't have a target date fund, or I don't use a target date fund, and here is why. Your path can be different. Okay, so target date funds are perfect for people who start in their 20s or early 20s, their first job, and then plan on ending it or leaving their job or what have you right at about that target date. It's great for traveling straight lines. But what if you, for whatever reason, I don't know, graduate into a recession and you didn't have a target date fund and you didn't really start investing into your 30s? Well, now what? Does that mean that you need to pick one that is like, what is your date now? Is it still at 65? Is it 75 now? Which we obviously hope that's not the case. That makes things a bit more difficult. What if you're in your 50s and you're just now starting to invest? A target date fund, a regular target date fund, might not make that much sense because you would pick a target date fund that's 15 years from now. So you're talking at 2035 now, right? Or 2037, you want to be exact. Y'all get the point. But if I did that, then what, right? Investing for 15 years, target date funds is not really going to be it may not be, I'll say that, it may not be the best, most appropriate thing for you because it's going to start you as if you were investing this entire time. You might have to be more aggressive. Maybe, right? Depends on what your goals are when you plan on retiring and all those sorts of things. So if you are somebody that, A, wants to be on autopilot and you're starting early and your financial life is very straightforward, target date funds are great options. If you're somebody who has to catch up and perhaps you weren't investing for certain periods of time, you can still use a target date fund, but be more aggressive. Choose a date that makes the most sense. Choose a date that you feel you would be comfortable retiring in, because that's what this target is for. It's going to glide in that direction. So those are the things you really want to pay attention to. Why don't I use target date funds? Because I plan on being just a touch more aggressive, and that is the other, I guess, disadvantage here. Target date fund has its risk tolerance set up, and that it is what it is, right? So if I am somebody who's in my early 30s, and I say, look, the target dates fund is an example. Target date fund says I should be 70% stocks and 30% bonds. But I took my own risk tolerance questionnaire. I have used the rule of 110. I've done all this stuff, and I have determined that my personal risk tolerance, based on what I want to do and what I can tolerate and see in the market, maybe I'm 80-20. Well, if I'm 80-20, I can take on more risk. My portfolio, in theory, should grow more aggressively and have more money. But the target date fund has me at 70-30. I'm not going to see those returns, and I might not be okay with that. That's the other part of it. The disadvantage, though, if you are doing these things on your own, is you got to do these things on your own. You have to go in there and make these adjustments to your portfolio. You have to go in there and make sure that you're properly allocated and rebalancing and doing all that kind of stuff. I am fine with doing that. That's what I do twice a year. I enjoy doing that to a degree. I know it's weird and nerdy, but that's just me. That's not everybody. So you have to fit the investment with your personality. Fit the right investment for who you are. Do you want to be on autopilot? Is your financial situation just clear and straightforward, yes or no? And then use those two things to help you determine what and if a target date fund works for you and which one works for you. So that's it. That's what target date fund is. It chooses a target for you. It has a mix of stocks and bonds, and it glides down to a more conservative portfolio to help you retire super, super easy and build wealth again on autopilot. It's one of the easiest, most simplest things you can do, and I love the concept of it. Disadvantage again, is that your path? Do you want to be more aggressive? Are you able to customize a bit more, yes or no? That answer is no for a target date fund, so you have to be a little more savvy if you choose to do anything outside of that, which you totally can do, but again, makes things just a tad bit more difficult. Okay, so let me know what you think about target date funds. These are some of the most popular options inside of 401ks, and for good reason, because you really shouldn't be doing all that much in your 401k. In either case, that is what they are. So let me know what you think in the comments below. If you have any other questions that you want me to answer, feel free to let me know. And obviously, as always, check out the members only tomorrow, unless I can record it tonight, unless the kids are asleep, because they didn't go to sleep yesterday. So unless I'm gonna the list of 10 stocks I want to cover, obviously I already have 5 of them, and I have the list here. That looks like about 13 total. I'm gonna narrow it down to 10 tonight. So I'm gonna try to either record it tonight and put in the members only, or do it at some point on Friday. My schedule is a lot more free. In either case, you want to be in the members only so you can get the full list of 10. If you don't know what I'm talking about, I put out a list yesterday of 5 stocks that are doing quite well in 2022, and based on what we know about the market and the economy, you might want to keep an eye on. One of them was McDonald's. Another one was Waste Management. That's MCD for McDonald's and WM for Waste Management. And I've got several more that I want to discuss. But I'm only discussing this and having this conversation with those inside the members only. So you want to make sure that you click the link right here and make sure that you like and subscribe. And again, leave a comment. You got any thoughts or questions? I'm here to answer questions for you. It's literally what I do. I wait here until people ask me questions. So that is it for me. Let me know what you think, and I will see y'all tomorrow. All right, talk to you later.